Every single trading day, price follows the same three-phase pattern. ICT calls it the power of three: accumulation, manipulation, distribution. Once you see this, you cannot unsee it. Phase 1, accumulation. During the Asia session, price coils in a tight range. Smart money is building their position quietly. You'll see small candles, no real direction. This is not randomness. This is intentional. Phase 2, manipulation. Right at the London Open, price breaks out of that Asia range. But here's the trap. It breaks the wrong way first. If smart money is long for the day, price dips below the Asia low to sweep the stops of early buyers. That stop hunt is the manipulation. Phase 3, distribution. Once the stops are swept, price reverses hard and moves in the real direction all day. This is where you make money. You enter after the sweep, not before it. Here's how to trade it. 1. Identify the Asia range before London opens. 2. Watch for a break below the Asia low at London Open. That's the manipulation. 3. Wait for a candle close back inside the range. Then enter long, targeting the Asia high and beyond. Your stop goes below the manipulation wick. Risk is tight. Target is the full day's distribution move. This plays out on BTC almost every single trading day. Our platform runs this framework automatically. It detects the Asia range, identifies the manipulation sweep, and uses CISD to confirm the delivery direction before placing the entry. Early access at smartinggoods.com. Most traders use Fibonacci wrong. They draw it and then just guess where price might stop. The OTE, optimal trade entry, is ICT's exact answer to that problem. Here is what actually happens. Price forms a swing low right here. Then price rips up impulsively, breaking structure, leaving imbalances behind, and forms a swing high. Now smart money needs to reaccumulate before the next leg up. They don't chase price. They wait. So price pulls back, and it pulls back into a very specific zone. You draw the Fibonacci from the swing low to the swing high. The OTE zone is between 62 to 79% retracement. That is where institutional buy orders sit. Not at round numbers, not at obvious support. Right there in that zone. But here is what makes it high probability: confluence. In this example, we have a fair value gap sitting right inside the OTE zone. Smart money left that gap on the way up, and now they come back to fill it. When the Fibonacci zone and a FVG overlap, that is your signal. Here is the trade. You enter at the 70.5% level, the midpoint of the OTE zone. That is the center of institutional interest. Take profit 1 at the swing high, the liquidity above. Take profit 2 at the next major level beyond, and the stop goes below the swing low. Clean invalidation, tight risk. 3 rules for a valid OTE. 1. Higher time frame structure first. Only take longs when the 4-hour trend is bullish. Never trade against the HTF. 2. Price must be in discount for longs. The OTE zone needs to be below the 50% equilibrium level. 3. London or New York only. OTE setups in the Asia session or dead zones fail constantly. Wait for the kill zones. Our platform detects OTE zones in real time, runs this on live BTC charts, identifies the FVG confluence automatically, and flags when the zone is active during a kill zone. Early access at smartinggoods.com. Most traders think gaps are random. They're not. In ICT, every fair value gap is a map, a precise record of where smart money left orders behind and exactly where price will return to collect them. Here's the structure. 3 candles create a fair value gap. The first candle sets the high. Then a massive displacement candle fires. That's the delivery move, the candle where institutional orders flood the market and price moves violently in one direction. The third candle opens above the displacement candle high. The gap between them is the imbalance, an area price skipped over too fast to fill orders on the way up. That untraded region is your FVG. Why does it work? Smart money left orders in that gap. When price returns, It's not random support or resistance. Price is drawn back to fill institutional imbalance before continuing its delivery. Every single time you see price tag that FVG and reject, you're watching banks top off their position before the next leg. Here is the trade setup. When price pulls back into that gap, you're ready. Enter at the midpoint of the FVG. That is the 50% level inside the imbalance. Your stop goes below the displacement candle low, protecting you from a full structure break. Your take profit sits at the next liquidity pool, the unswept buy side resting above the recent swing high. 3 rules you must follow. Rule 1. The FVG must form in the direction of the higher time frame trend. If the daily is bearish, you're not trading bullish FVGs on the 15-minute. Rule 2. Only trade the first fill. Once an FVG is 50% filled, it's spent. The second test of that same gap is where retail gets trapped. You want the first return. Rule 3. Session kill zones only. FVG setups during dead hours get chopped. London Open and New York Open are your windows. Outside those, you're gambling. Our platform detects fair value gaps automatically on live BTC. Every displacement candle, every unfilled zone, every optimal entry point mapped in real time. Early access at smartinggoods.com. Every big move in the market starts from the same place. An order block, not a random candle, not a support zone drawn on a whim. A specific structural footprint left behind by institutional traders when they needed to fill massive positions. Here is what an order block actually is. When smart money wants to go long in a big way, they cannot fill millions of contracts at one price. So they sell, aggressively, to create the liquidity they need to buy from. That aggressive sell creates what looks like the last bearish candle before a bullish displacement move. That candle is the order block. The displacement move that follows is your confirmation. Price rips away from that zone with strong, impulsive momentum, leaving behind a fair value gap in many cases. That gap and that order block zone are where institutional buy orders were partially filled. Here is the key insight. Not all of those orders got filled. Smart money still has open buy orders sitting inside that zone. So they engineer price to return to the order block zone. And when it does, price reacts. That rejection is your entry signal. Your trade setup is clean. Enter at the 50% level of the order block candle. That is the midpoint of the OB body. Stop goes below the low of the order block with a small buffer. Take profit at the next major liquidity pool above. The nearest buy side liquidity. 3 rules to keep your order blocks clean. Rule 1. It must be the last bearish candle before the displacement. Not any bearish candle. The final one right before the impulse begins. Earlier candles do not carry the same institutional weight. Rule 2. For a bullish trade, the order block must sit in the discount zone of the current range, below the 50% equilibrium. Smart money buys in discount, sells in premium. Do not chase order blocks forming at premium prices. Rule 3. Look for an FVG confluence inside or directly above the order block zone. When a fair value gap aligns with the OB, you have 2 layers of institutional interest stacked at the same price. That confluence dramatically increases the probability of a clean reaction. Our platform identifies order blocks automatically on every BTC timeframe, flags the moment price returns to them during kill zones, and highlights when FVG confluence is present. Early access available now at smartinggoods.com. If you don't understand market structure, you are trading blind. Every professional trader, every smart money operator reads the market through 2 signals, CHoCH and BOS, change of character, break of structure. These 2 labels tell you everything about trend direction and when it is changing. Let's start with break of structure. When price is in an uptrend, it makes higher highs and higher lows. Every time price pushes above the previous swing high, that is a break of structure, a BOS. This is continuation. This is smart money confirming the trend is still alive. You do not fade a BOS. You trade with it. Now here is where most traders get confused. After a series of lower highs and lower lows, a clear downtrend, Price suddenly breaks above a prior swing high. That is a change of character. That is a CHoCH. The market is telling you the trend is changing. This is the earliest entry signal you can get. Most retail traders miss it completely because they are still waiting for confirmation that never comes. Here is how you trade the CHoCH setup. Enter on the CHoCH candle close, the candle that closes above the prior swing high. Your stop goes below the CHoCH swing low, which was the last significant low before the break. Take profit at the next major liquidity pool above. Prior highs, untouched BSL, equal highs. 3 rules to keep your entries clean. Rule 1. CHoCH must break a significant swing high, not just any wick or noise. The level needs to have been tested and held before. Rule 2. Wait for a candle close above the level, not just a wick through it. Wicks lie, closes confirm. Rule 3. Only trade CHoCH in the direction of the higher timeframe trend. If the daily is still bearish, a 15-minute CHoCH is just a pullback, not a reversal. Our platform tracks structure shifts in real time and alerts you to valid CHoCH setups during the London and New York kill zones. The only time smart money is actually moving price. Get early access at smartinggoods.com.